Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk about everything you need to know about capital gains tax, which might sound like a pretty boring topic, and certainly I would agree with you in that, but it's an important one, particularly as investors, particularly as we hope to generate substantial capital gains. We want to make sure that we're investigating and utilising every opportunity to reduce the tax that we might eventually pay. Before we get there, just as a reminder for the month of December, we are discounting any book purchases. So Investopoly or Rules of the Lending Game, the two most recent books that I've written. And we will send them to you for $20 and you won't have to pay for postage. We'll pick up the postage. So if you're interested in something like that, just head to the website. The discount code or coupon, whatever you want to call it, is BLOG, B-L-O-G. It's not case sensitive, I don't think. Well, I'm pretty sure it's not case sensitive. And so just use that code, say $20, no postage. Okay, let's get into the more exciting topic of capital gains tax. And I guess the first thing I will say is it's not necessarily bad. Paying capital gains tax means that you've sold an asset and made a profit, which of course is much better than making a loss. So if you've got to pay some tax, it's actually not a bad outcome and it's a good indication that you've done well. Now, of course, most people would rather pay less tax than more. So, it's important to know the kind of ins and outs. So let's start with the basics, I should say. How is capital gains tax calculated? Well, there's 4 components to the formula. It's net sale proceeds minus cost base, divided by 2, or apply a 50% discount, multiply that amount by your marginal tax rate. Now, I've got links in the show notes and blog on the website that set this formula out. Maybe it's easier to digest it than via a podcast, but let me talk to each of those 4 items. So the first one is we start with our net sale proceeds, and that really includes anything you've received from the sale of the asset, less any direct selling costs. With property, that could be advertising, agent fees, legal fees, and so forth. With shares or other assets, could be brokerage fees or professional fees. If you've gifted or sold the asset to a related party for less than market value, then your deemed sale proceeds is equal to market value. Whereas if it's an arm's length sale on market sale, then it's really just what you've received less any costs. So that's the starting point. That's what you've received from the asset. Then you've got to subtract from that what you call your cost base. And that's really the total cost of the asset. So it obviously includes what you originally paid for that asset, plus any related acquisition costs. So for property, it could be stamp duty, buyer's agents fees, advice fees, legal fees, professional fees, etc. And for shares, it's probably going to be brokerage. Maybe you've got some advice fees, legal fees perhaps, and so forth. If you've incurred any holding costs during the time you've held that asset and haven't claimed a deduction for those costs in the year that they were incurred, then you can add them to your cost base. And similarly, any capital improvements. So if you made any capital improvements, you can obviously add that to your cost base, less any depreciation or amortization that you might have claimed during the ownership period. So net sale proceeds less cost base gives you your gross capital gain. Now, if you've owned the asset for more than 12 months and you're an Australian resident for tax purposes, you're entitled to reduce the net capital gain by 50%. So that gives you what's called your discounted capital gain, and then you need to multiply that amount by your marginal tax rate, because essentially that discounted capital gain will go into your tax return and it will be taxed at your marginal tax rate. So, for example, if you earn between $120,000 and $180,000 a year, your marginal tax rate is 39%, including the Medicare levy, so multiply that amount by 39%. Now, if the gain sends you above the highest marginal tax rate, so over 180, well then anything over 180 is going to be taxed at the highest marginal tax rate, which is 47%. But that's essentially how to calculate what your capital gain might be. And that's pretty relevant. People tend to start thinking about this when they're contemplating selling an asset, and they really need to calculate what will they walk away with in terms of cash after selling the asset. Now, of course, if you make a capital loss, that means that your net sale proceeds are less than your cost base. Losses can be used to offset other capital gains that you've made in that particular year, so you obviously should certainly do that. However, capital losses cannot be used to offset other income such as PAYG or business income, so forth. Instead, you must carry forward a capital loss and offset it against a future capital gain. So losses need to be quarantined. Now, we're all familiar that our main residence doesn't attract capital gains tax. So let's talk a little bit about that. So there's three elements that you need to consider to be eligible for 100% main residence exemption, which means your home doesn't attract capital gains tax. The first one is that you and your spouse live in it, that it's actually an owner-occupied residence. The second, that it's not used to generate any income, so you're not renting out a room or you haven't rented it out previously. And the third is the land size is less than 2 hectares, less than 200 square metres. So they're the three elements. If you can tick all those three boxes, then you are it's very likely you're entitled to the main residence exemption. Now, you and your spouse can only nominate one main residence. So if you're lucky enough to have two homes, maybe a city residence and a treeside or beachside property that you occupy from time to time, only one of those properties can be deemed as your main residence. And of course, you'd pick the one that's going to have the lower capital growth prospects, I would have thought. But essentially, you can only apply one main residence exemption at any one particular time. Now, there's various rules for different situations, such as your main residence being on multiple titles, you've got adjoining vacant land, or if you've got multiple dwellings on the same title, or if you go and subdivide your main residence, etc., etc. So these are very kind of unique circumstances, and it all depends on the rules and situations. So it's always good to go and speak to, or very wise to go and speak to a holistic accountant to get some direct advice. And now what happens if you convert your main residence into an investment property, which is pretty common, people upgrading and then renting out their former home? Well, the capital gains clock will start to tick, particularly if you've upgraded, because now you're claiming another property as a main residence. You can't continue to claim your former home as a main residence as well, so it'll start attracting capital gains tax. Now, how that's calculated depends on the immediate use of that property when you first purchased it. So, for example, if you occupied the property immediately after you purchased it, your cost base will be deemed to be the market value on the day that it first became available for rent. So pretty simple. If you bought a property, 500 grand, you lived in it for a few years, you moved out, it was worth 750,000 when you moved out, and you went upgraded and bought another main residence. Well, any growth beyond 750,000 will start to become subject to capital gains tax. However, if you initially rented the property, so tenanted the property when you first purchased it, then occupied it, and then upgraded at that particular time, then you have to prorata the capital gains tax by number of days of ownership. Bit confusing. Let me give you a really simple example. Let's say I went out and bought a property and put a tenant in it for 2 years. Then I occupied it. So the tenant left. I occupied it for 5 years. Then I rented it out again for, say, another 3 years. So I've owned the property for 10 years, but for 5 of those years I've occupied it, and for 5 of those years it's been rented out. In that situation, I will be entitled to half of the main resident exemption. So for half of that time, or half of the gain will be tax-free, and half of the gain is going to be taxable. And that's because it was an investment property right from the beginning. So first day there was a tenant in it as opposed to me occupying it. So a couple of different rules there around renting at a former home. There's a nice little rule called the 6-year rule, which allows you to continue to claim a main resident exemption as long as you don't claim another property as a main residence. And it was really put in place to sort of help or assist expats going overseas or moving around the country and so forth. So it means that if if I've got a home, I've lived in it for 5 years, then I decide to go and work in another state, and I'm going to go and rent somewhere else, then I've got up to 6 years to continue to claim that main resident exemption, even though I'm renting out my home and earning an income from it. And so that means that if I go and reoccupy the property before that 6-year period is up, or I go and sell it, I'm not going to pay any capital gains tax. If I don't do that before that 6-year period has expired, then I lose the exemption for that period, and it's then really based on the market value of the property at the time. So something that's worthwhile using. Also, if I reoccupy the property before the 6 years is up, and then vacate it again and put a tenant in it, again, I can utilise multiple sort of 6-year periods if I'm able to do that. A good way to sort of, generate some tax-free growth. There's not a lot of things in life that are tax-free, so if they're available, certainly we should try and avail ourselves of them. So let's talk about some entities now and some uniqueness, I guess, around companies and trusts and super funds. So the most unique thing about a company is that it's not entitled to the 50% capital gains tax discount. That means that any capital gains in a company are taxed at the flat company tax rate. So really, net sale proceeds minus cost base times the company tax rate. Now, if there's two company tax rates at the moment, 25% and 30%. So if your company is what's called a base rate entity, it will be entitled to a 25% tax rate. And in that situation, it's not too bad, because really the highest individual tax rate for a capital gain is about 23.5%, being half of the top marginal rate of 47%. So in an individual name, you've got 23.5%. In a company base rate entity, it's 25%. You're not too far disadvantaged. However, if the company doesn't qualify as a base rate entity, then the capital gain is going to be taxed at 30%. And that starts to become too prohibitive. So if you are going to use a company, it's something to really think carefully about whether that company will qualify as a base rate entity. And essentially that means, can you distribute some business income into that company so that more than 20% of its total income is business income? In that case, there's a chance you can qualify as a base rate entity. So something particularly for people that are self-employed that have that flexibility to really think carefully about. If a family discretionary trust makes a capital gain, of course, we know that family trusts can distribute income and capital gains to various individuals or entities. It depends on what their trust aid says, but most trusts have very wide sort of distribution powers. And the capital gain retains its tax nature and attributes. That means the capital gain will really be taxed in the hands of the beneficiary. And whether that beneficiary can use the 50% discount and whether they can offset against other losses and so forth will really depend on the beneficiary's tax position. So it really kind of just flows through. So if a family trust distributes to a company, for example, well, that wouldn't be wise because you've lost the 50% capital gains tax discount. Well, wouldn't be wise if the company didn't have any capital losses, of course, but if it has capital losses, maybe it's a good thing. Super's always a concessionally taxed environment, and we know that in an accumulation phase, so the phase before retirement, super funds are taxed at a flat rate of 15%. Now, with capital gains tax, its discount isn't 50%, it's 1/3. So essentially, by discounting the gain by 1/3, you're essentially reducing the effective tax rate to 10%. So during accumulation phase, all gains are taxed at 10%. In retirement, as is very well documented, the tax rate is nil. So no tax on capital gains or income. It's one of the great attractions, I think, of accumulating at least some of your wealth inside super. Now let's talk about inheritance now and how capital gains tax works with inheritance, because often it's a surprise that you inherit the cost base and the nature of the asset from the predecessor, which is obviously the person that's gifted or bequeathed these funds or assets to you. So that means if you go and subsequently sell an inherited asset, so quite common it's some shares, you get a parcel of shares, you'll be taxed on the full capital gain of that. So it really depends on when the predecessor purchased it, how much they paid, and then you'll be taxed according to normal sort of situation as if you were the original purchaser. Of course, if you're selling someone's former home, you still might be able to utilise the main resident exemption, so that could be capital gains tax free. And if the predecessor purchased any assets before 20 September 1985, so that's sort of what we call a pre-CGT asset, then your cost base is deemed to be the market value as at the date of death. So at least there's no capital gain on any unrealised gains until the date of death. So let's talk about how to minimise capital gains tax then. Now we know the rules. It obviously depends on your circumstances and most importantly your long-term plan. So there could be various ways in which you could minimise it, but maybe a couple off the cuff, off the top of my head. I think the first one is crystallising a capital gains tax event in the financial year that's going to be most economical. So if you're 2 years away from retirement, delaying the sale until post-retirement, and your income, you'll be able to forecast what your taxable income might be in retirement, but it could be nil, and that might save you a bit of money in terms of delaying selling an asset. Of course, sell assets in the right order. So sell assets that are expected to crystallise a capital loss first. One of the challenges with selling assets, maybe not shares but property, is you don't know really when you're going to be able to sell it. It might take longer than expected, for example. So at least you can carry forward a capital loss, but you're going to have to pay tax on a capital gain whenever it's incurred. So selling the assets that are going to make a loss first makes sense. Selling down assets gradually over many years is obviously a better thing to do than lump sum sales. Clearly that's easier to do with shares than property, but something to consider. Being a bit more proactive with respect to structuring assets, particularly around CGT liabilities, and really your long-term plan will inform you about whether you need to sell down assets at any particular time, or at least the likelihood of needing to sell down assets at any particular time. And if that likelihood is high, then thinking very carefully about minimising capital gains tax well before you actually make those asset purchases. And then being proactive around determining and planning the best use of your main residence exemption as well. Again, there's not too many things in life that are tax-free, so if there's a exemption there, you should certainly make good use of it. Okay, so let me just wrap up then and say that when it comes to tax, there's almost always special rules, treatments and exemptions, which greatly depend on your personal circumstances. So whilst this podcast is very accurate, of course, and seeks to summarise the rules, there could very well be something unique about your circumstances, which means that they apply differently. So therefore, it's very important that you go and seek personalised tax advice before you act on any information in the podcast. Okay, that's it for this week. Until next week, bye for now.